Welcome back. Today we're going to talk about four key manufacturing indicators and answer the question, how does manufacturing today compare to 2008? We're going to take a look at the Empire State Manufacturing Index in New York, Philly Fed, industrial production, capacity utilization. And again, what we want to know is what these numbers look like in the 2007 2008 time period and how that matches up to where we are today. Starting out, Empire State Manufacturing, it provides insights into the manufacturing sector specifically in New York State. Today, readings negative 2.4 to the downside from a negative 43.7 the prior month. Now, overall, most of the numbers we've seen have been in negative territory. Today is no exception, negative 2.4. Certainly an improvement from the prior month. That negative 43.7 is very significant. We're going to see in just a moment why negative 40 is such a big deal. Now, compare this to what we look like in 2007, 2008. By the way, the white line is the Fed funds interest rates. And specifically notice how the manufacturing histogram bars really turned to the downside and negative while interest rates were going down. You see, they cut interest rates because the economy was significantly weakening in 2008. Well, manufacturing is no exception to this. Manufacturing is very sensitive to economic turndowns, and certainly this held true in 2008 as well. Well, where we are today looks very similar to where we were around July of 2008. Now, this is not to say that we're going to follow the 2008 period as a template, you know, dollar for dollar, so to speak. But it is interesting to see how we're both in negative territories and the chart patterns do look similar. Now, how do we compare to the 2007 2008 time period? Empire Manufacturing, it looks like a lot where we were in July of '08. Philly Fed, it provides insights into the manufacturing sector in the 3rd District, specifically Eastern Pennsylvania, parts of New Jersey, and Delaware. The Philly Fed today, positive 5.2, prior report negative 10.6. We can see here Philly Fed 5 consecutive reports in the negative territory, now positive 5.2. What does 5.2 look like historically? Well, manufacturing in the Philadelphia region certainly did decline with the last round of interest rate cuts in 2008. 5.2 looks a lot like where we were around November of 2007 when we registered a 6.6. And notice that occurred right before a very significant streak of negative candlestick bars throughout the 2008 year. Now, how do we compare to the '07-'08 area? Philly Fed looks like November of 2007. Industrial production measures the output in manufacturing, mining, electric, and gas industries, established in 2012 with a baseline of 100. So if it goes to 110, it's 10% better than the baseline. 90, a 10% decline. Where are we now? U.S. industrial production unexpectedly edges down 0.1%. It was a very small move to the downside. But we can see here we're now at 102.57. We've seen about 4 reports in a row in this area. It seems to be treading water. But historically speaking, not really a great number in the sense that we look like we're at the peak of what could be the beginning of a slide to the downside. These charts do look like the industrial production numbers usually trail the other numbers for whatever reason. Perhaps it's the mechanics of the way they calculate the number, but it looks like the industrial production seems to be a little bit of a lagging indicator. And at this point, it looks like where we were around November of '07. So we can see here, Empire Manufacturing looks like July of '08. Philly Fed industrial production looks like November of 2007. Finally, capacity utilization. It measures the extent the manufacturing and industrial sectors are utilizing their production capacity. Now, it represents a percentage of the actual output relative to the maximum capacity. So the higher the capacity, it indicates a better efficiency in economic activity. If we're running at 100%, it means that the manufacturing index and the industry is running at full capacity. Well, right now, we're not at full capacity. We're at 78.5%. That's not really a good number. In fact, it's the lowest number we've seen since September of 2021. We can see a precipitous drop to the downside. Again, 78.53. It's the lowest low we've seen in several years now. What does that look like historically? It looks like where we were around July of 2008, in the midst of an interest rate cut, in the midst of an economic downturn. So, how do we compare overall with all four numbers? The Empire State Manufacturing Index looks like where we were in July of '08. Philly Fed Industrial Production November of '07 and Capacity Utilization July of '08. Now, again, this is not to suggest that we're going to follow dollar for dollar where we were in the 2008 slide. Every economy is different. However, with that said, all of these numbers do look like we're on the cusp or in the midst of a slide to the downside in manufacturing. We've reported about the weak manufacturing sector in the past. It looks like things are worsening. Now, specifically Empire State and Philly Fed, they seem to be more sensitive numbers, and they're reported on the state level, specifically New York State and New Jersey, Philly area. What does a recession look like with these particular numbers? And remember, we said negative 40 is important. Well, this shows us those two numbers, Empire State and Philly Fed, going back to '01. The yellow line represents Empire State, blue Philly Fed. In 2001, we saw a tech slowdown, a tech recession. We hit lows of 23.6 to the negative side. We did not hit negative 40. Negative 40 is the really significant level. And the technology slowdown in 2001, was a recession, but it was very short-lived, and it really did not affect manufacturing as much. And that's why we had a rather shallow downturn. Conversely, in 2008, we hit levels of negative 40.9, touching that negative 40 level. That shows us a deep recession where manufacturing specifically is very much hindered. The 2019-2020 COVID recession was very short-lived, relatively speaking, only a few candlesticks, a massive recovery. We did hit very significant lows of 78.2, but very quickly bounced back to the upside. And I think not only the depth of these candlesticks, but also the longevity. How long did this recession, did these negative numbers last? And with that question, here's the answer of where we are now. This seems to be currently the longest lasting slump in manufacturing that we've seen in quite a long time. It looks like these numbers are consistently in negative territory since 21, 22, and we've had four instances of negative 30 or more. And we know now recently the numbers look like they're treading near the zero level. However, that has happened in the past. It is concerning that we're in negative territory for such an extended period of time. And so easily these numbers dip into very severe negative territory. Now, going to our Fed Watch, we take a look at our economic calendar, specifically targeting the March interest rate decision, and we want to see how these numbers on the economic calendar affect our chances of an interest rate cut in March, as well as the S&P 500. Today, industrial production and capacity utilization were to the negative. We color those red. Empire Manufacturing and Philly Fed, those were improvements. We color those green. Nevertheless, we have 11% chance the Federal Reserve will cut interest rates in March. They're most likely not going to. S&P 500 is at 50.20. It does mark a bounce off of those lows of 49.19 the other day. You remember that CPI number really shocked the market. The S&P 500 went down quite a bit. We're back up to the 5,000 level on S&P. With very, very little chance that the Federal Reserve is going to cut interest rates. Now, with all that said, Certainly, this also affects the housing market, also an extremely sensitive industry to interest rates and to any prospect of an economic slowdown. And we consider specifically the monthly supply, the inventory of new houses. Our most recent number shows us an 8.2-month inventory. It means at current rates, if we were to sell every house in the inventory, new homes, it would take us 8.2 months. This is actually a low number. We were at 10 months in July of 22. Now, the reason why we mention this is because we have put together a very significant an interesting research piece in Substack.com. It's our newsletter where we take a look at some very significant data. Just enter in just the data over here, and you'll see in particular the lock-in effect. The lock-in effect occurs when we have low inventory. We have low inventory in this particular case for two reasons. Home builders don't have a lot of confidence, but also potential home sellers don't want to sell because they have a mortgage with low interest rates. And if they sell their house, they're going to buy another house and then they're going to end up with a high interest rate mortgage. So they're locked into their current house and they just don't want to sell. And this causes very low inventories, which is the phenomenon that we're looking at right now. Well, we took a look at some prior periods of time when the lock-in effect also took place, specifically 1990 and the early 2000s. And we looked at the economic numbers, specifically CPI and non-farm payroll, or I should say the unemployment rate, to see how we got out of this lock-in effect and what signs we should look for. Now, it's absolutely free. No registration required. Just simply visit just the data under Substack, and you can read this as well as all of our other publications. We hope this has been helpful. We look forward to seeing you back soon.